Well, thank you very much for having me. I'm sorry I'm not there with you in person in Australia, but maybe next time. Today, we're going to chat a little bit about building technical strategies for both more offensive and defensive approaches, kind of depending on your goals, depending on your risk tolerance. I do have the little Q&A up on the screen next to me, and I don't mind a question during the presentation. It helps me kind of know if we're on track and everything's making sense. So don't hesitate to pop a question in if you have one as we go along, and I will try to remember to look over and grab those from you as we go. All right. So, what are we talking about today? We are, I'm preaching to the choir here. We are all technical analysts or those interested in technical analysis. And TA gives us a really fascinating and deep tool set to pull from if you're looking to build more systematic based trading strategies. We have this wealth of data, wealth of analysis techniques, indicators, and these can all be pulled together into really great building blocks for a systematic approach to trading. So today I'm going to give you kind of two examples. I'll walk you through a more offensive, aggressive approach. We'll talk about some relative strength approaches to investment management. And then I'll walk you through the process of building an approach that has more of a defensive bent, more of a risk management bent. And TA really offers us a lot of tools for both. On the RS side, I'll take you through more of a kind of historical and survey approach. And as we get into the defensive side, I'll talk a little bit more both about building that strategy and then using an example, kind of the process to test and build one of these, and kind of what those steps and pitfalls can look like. So what is a strategy? A lot of these words get used different ways. When I'm talking about building a trading strategy today, what I'm usually thinking about is something that's a systematic approach. It's something that has a set of buy and sell rules or position sizing rules that we are building to meet a specific objective. That often has to do with either a specific return profile, whether you want to beat an individual benchmark, or it could be around a risk mitigation profile. You want to manage your risk down below a certain type of drawdown. And, the real key here is that rules-based idea that there's a set of rules that you've developed that are telling you what to do. You're not this is more the science in the art and science side of TA. And the other piece is that it's driven by data, by something really structured that we've looked through. So the key to success in this area is making sure that it has a really rigorous, tested foundation and that we're not using our emotions when we're deciding to enter and exit. It's by far the hardest thing in trading, forget technical analysis. At the top, we are all excited, things are growing, we want to buy more. It's really hard to make that exit at a top. And at the bottom, when things are looking disastrous, it's really hard to say, yep, I'm going in now. And so having a set of rules and a system that you've tested and that you've used and you have confidence in really helps guide us in those scenarios and kind of gives that structure and peace of mind to make those entry and exit decisions. I forget who said it, but there's a quote that goes around that says the market will always surprise you, but your methodology never should. This is kind of trying to get to that point, making sure that you have hammered out that methodology that's going to work for you. So the golden rule, and we'll get more into this in the second half of the presentation, but really the core thing for system success is not over-optimizing. If you test and tweak and test and tweak and test and tweak, you'll come up with something that looks really beautiful for your historical period that you're testing on and something that will almost certainly immediately flop when released into the real world. So it's that really delicate balance of testing enough to have confidence in your system, but leaving out of sample data to run a final test on and not over-optimizing and not allowing yourself to tweak that final time and ending up with a super over-optimized system. So It's kind of the preview. Getting into the meat of it, our offensive example today is building a portfolio using a relative strength-based methodology. So what is relative strength? Relative strength is really the measure of the performance of one asset against either a benchmark asset or a group of assets. So is your stock or your asset growing faster than the index that it's measured again, or faster than the group of assets that you're analyzing? This gets used quite often interchangeably with momentum. There are some differences there actually, but it's that same kind of idea there. This idea that you want to buy the thing that is accelerating, that is moving up and is moving stronger than its peers. And the idea here is that there's some stickiness to that. So if we find an asset that's begun to outperform, that it's likely to continue outperforming at least for an interim period, and we can capture some of that outperformance for ourselves. So the core idea here is that we want to own strong assets, right? We want to own the assets that are delivering performance. If you look at the little picture, you want to invest in that front group of runners, the guys leading the race. And as they drop back into the pack, we might let them go and pick the next guy who's going to pick up the lead there. If you own the index, if you own that giant herd of everyone in the race, you'll get their performance, but you won't get anything extra. This is really classic sort of technical analysis. We're looking at price and we're letting price guide our portfolio performance. We're letting price guide our asset selection. What it is also fundamentally almost always going to be the opposite of value investing. So if what you look for is kind of that big base stock that's just coming out of a long big base and is really well valued and kind of down there, relative strength is probably not going to capture that stock for you. This is about sort of getting that high flyer with the expectation that it flies higher. A mentor of mine once jokingly said, what is every stock that's gone up 500% done first? And the answer for him is go up 100%. So it might seem counterintuitive to buy something that's come so far, but in this particular theory, you're looking at something that's come far with the expectation to go farther. So kidding, not kidding. When we talk about relative strength, a lot of people mentally jump immediately to RSI, the relative strength index, which was developed by Wells Wilder. It's a great tool, great indicator. It's an oscillator that lets you get a sense of overbought, oversold conditions. Not the piece of the universe that we're talking about today. Relative strength and RSI live in quite different spaces. So a little bit of a joke because I've gotten a lot of RSI questions. So relative strength, what we are talking about today, usually gets expressed in one of two different ways. The first is a relative strength line on a chart. And you'll see sort of as that, you'll map basically one asset against a benchmark. And, that line will turn up as that asset outperforms its benchmark, and it'll turn down as the asset underperforms the benchmark. Also a really great tool. Not exactly the approach that we're going to look at today. We're going to take that ranking approach where we use a relative strength calculation to rank a little universe of stocks that we're looking at as potential investments, and then based on that ranking, make our buy and sell decisions. So the core foundation of relative strength portfolio construction is pretty straightforward. Get a group of stocks. You calculate a relative strength score for each of those stocks. We'll go through a set of historical examples of relative strength scoring in a moment. And then you rank that list of assets based on the relative strength score that you've just calculated. You buy the strongest of them. Could be 5, 10, 20, 500, whatever your appetite is for your position sizing. And then as an asset that you're holding starts to lose strength compared to its peers, you'll sell that out of your portfolio and you'll replace it with something else that has gained strength, and is now in the leadership. So what I'll take you through next is a set of examples of how to calculate relative strength scores. These are all examples that have been in the public domain for, in many cases, decades. The interesting thing is that they all still work. This is one of those sort of fundamental, if you've ever heard my dad speak, his favorite thing is to talk about first principles, these underlying supply and demand dynamics of the market that just hold true over time, that speak to human psychology, that speak to fear and greed. And relative strength is one of those principles. So one of the earliest really successful practitioners in the relative strength base who's published about it is George Chestnut. He is notable partially because he ran a fund with a real track record based on this methodology starting in the 50s. He published about his methodologies in the 60s. He had an approach that was to start by looking at the relative strength and rank groups and sectors. And then once within a strong group, to rank the stocks within that group and select the strong stocks from within the strong groups. Robert Levy's approach is the first one that we're going to end up looking at in testing after this. He wrote his relative strength as a criteria for investment selection in 1967. And he wrote another piece, The Relative Strength Concept of Common Stock Forecasting, in 1968. He goes through a number of different methodologies in his writing, but ends up settling on an RS score that is basically a pretty simple 6-month rate of change using weekly data. Anything from this era usually uses weekly data because we're hand calculating and, we didn't all have data streams coming into our computer by the minute or second. So he just does the close divided by a moving average, a 26-week moving average, and he ranks all of his stocks by that 6-month rate of change. Norman Fosback wrote about 10 years after Levy. He wrote his book Stock Market Logic, and he took kind of an interesting approach. It's also a rate of change moving average based approach to relative strength, but he takes a longer moving average, a 30-week moving average, and then he looks at the rate of change of that longer moving average over a shorter period. So he looks at the 13-week rate of change of a 30-week moving average. So he takes a little bit of a longer data frame into account and then looks at that rate of change for a shorter piece of it. Moving forward another couple of decades, we get to Robert Pierce, Bob Pierce in 1997. Let's see. We do have a question that's come in that says, if you invest in a portfolio of strongest stocks, you would always be in the market. How would you suggest managing drawdowns when the market enters a bear phase? So I'm going to ask you to hold on that for the time being, because we actually have a whole section of the presentation that plays with a couple of ideas for that. But it is true that a regular RS system is always in the market, and if you don't include a risk mitigation piece, you do in fact see pretty dramatic drawdowns, and we'll see that as we get a little bit further into the presentation. So it's a good question and something that you definitely do want to take into account as you look at a system like this. So Pierce wrote a paper for the MTA journal, now the CMT, called A Practical Application of Alpha and Beta to Portfolio Construction. And he also had a really interesting way of conceptualizing this. He takes a 99-week moving average, and he looks at the 1-week rate of change, the most recent week rate of change for that 99-week moving average. But he wanted a little bit of volatility adjustment. So he deflates that rate of change by beta. But he has his own take on beta. He has a really trend agnostic. He doesn't care if it's volatile to the upside or if it's volatile to the downside. What he wants is a little bit of a volatility adjustment on that rate of change. So he calculates over a 2-week period, the current week and the prior week, the distance from the low to the high. Doesn't matter which order they came in. Doesn't matter if it started high and has fallen or started low and has risen. He's going to take that rate of change and deflate it by that magnitude. And so he takes a 39-week moving average of the beta so that it's not just the little piece. And that's something that does become really a fundamental consideration if you are developing your own relative strength calculations. Some of the strongest RS stocks will have huge volatility, huge short-term changes. And the question is always kind of trying to find a balance between capturing that real leadership and capturing those uptrends without ending up in a crazy piece of a meme stock that you really didn't want to take part in. So how do you kind of balance some of that growth versus that volatility to capture, I'll say medium-term trends, but really like the question is a trend appropriate to the time frame that you want to trade. The last of the four pieces that we're going to test is part of William O'Neill and the Investor Business Daily methodology. And if you've read his work, he does the whole CAN-SLIM thing that has both a combination of technical and fundamental components to his overall system. But a big piece of his approach is his own leaders versus laggards RS methodology. We're moving into the more recent past here. So he uses daily data, and he uses a combination of four different weighted rates of change. A 63-day, 126-day, 189-day, and a 252-day in 1 year. And he front weights it. He gives a 40% weighting to the 63-day and a 20% rating to all the rest. The thing to keep in mind is this is even more front weighted than it looks, because it's not just that you're giving a 40% weighting to the 63-day. It's that the 63-day is included in each of the three longer moving averages, longer rates of change as well. So this is an approach that really does quite heavily emphasize that front change, the most recent price action of the stocks that you're ranking. I included a little, we're not actually testing it today, but a piece about Charles Kirkpatrick's work. He had kind of an interesting approach, and since he passed away recently and I was looking back at his work, I thought it was worth including in here today as well. So he wrote a piece called Beat the Market, and then specialized in on relative strength in another paper in 2010. And he has quite an interesting sort of three-piece combination. He takes a really traditional relative strength calculation. He actually uses Levy's method on that 26-week rate of change. And he combined it with two sort of fundamental pieces as well. He looked at relative earnings growth and relative price to sales ratio, and he combined those three pieces into a rule set, where he bought things that were in the top 10% in terms of that relative strength component, the top 10% of earnings growth, and a relatively low price to sales ratio below the 30th percentile for that. So he tried to kind of ground in a little bit of that value investing sort of idea into it as well. And his sell rules were if price strength declines below the 30th percentile, so you'd buy it if your RS was in the top 10%, and if it fell out of the 30th, out it went. If its earnings growth declined below the top 50th percentile, he let it go, and he didn't consider that price to sales ratio as an exit criteria. So the company was growing and multiples were going up. He didn't mind as long as price strength and earning strength were continuing. So we won't come back to this in testing, but I think it's kind of a fun example of some of the hybrid that you can take between a purely technical approach while still considering some fundamental characteristics as well. And, maybe we shouldn't say this in a technical analysis presentation, but there's value in a bunch of the tool sets that are around, and they can be combined in some really interesting ways to reinforce each other. A little note to the critics as well. There's been a lot of academic study of technical analysis broadly, but momentum and relative strength have been one of the few that the Academy has had quite a bit of trouble disproving. The famous paper about relative strength is by Jagadish and Titman. But basically, a number of academics have studied this, and that idea that leadership, momentum, relative strength delivers outperformance over time, tests out time and time again, and does successfully deliver that outperformance. So those are a set of calculations. What if we actually want to build one of these? What if we actually want to put together a set of rules to buy relative strength stocks? What do we need to think about, and what does that look like? So the interesting thing here is that most calculations work pretty much any way you slice and dice this. If you're looking at the strongest stocks, buying the strongest stocks or assets, your choice, commodities, currencies, whatnot, buying strength works. They don't all work equally. Different approaches and different calculations are more effective in different asset classes, in different time frames, in different markets. And so it's very much worthwhile testing some different approaches. But by and large, and you'll see this borne out later, these do work. But you want to go through and do that adaptation. You want to probably not exactly use one of these that's been in the public sphere for 80 years. You want to tweak something so that it works for you and your risk considerations, your markets, your time frame. The real underlying piece here is that the universe of stocks, or the universe of assets that you're looking at, you can tell I trade more stocks than anything else, that universe is key. So relative strength is about buying strength. If the list that you are ranking does not have the assets that are driving your market performance, no calculation or slicing and dicing or any of the rest of it is going to let you capture that performance if it's not in your list. So a lot of people go straight to the calculations, go straight to, the portfolio construction. But the piece that you really don't want to rush through is thinking about what list you're going to trade from. Can be an index, can be a sector, can be something that you put together yourself. But this is really crucial. The other huge driver of performance is concentration. It's the number of portfolio positions that you have. I've run versions of these in real time with anything from 5 to 25 positions. The 5 position one tends to outperform. It has the accompanying higher level of volatility, because if something in that stock in your basket of 5 goes up 20%, you reap the benefits, and if it goes down 20%, you reap the consequences as well. So it's really about your comfort zone and what you want to trade. But concentration does tend to improve performance here up to the threshold of volatility that you're comfortable with. The other piece that I'm not really going to get into in the testing that we'll look at in the presentation today, but is also really, really important, is position sizing. To keep us from having a million permutations of everything, I just used equal weight positions as I did the testing for this. But there's really interesting things that can be done in relative strength with volatility weighting, with strength-based weighting. So you can either outweigh your highest volatility or underweight your highest volatility assets. You can give your top-ranked asset a bigger weighting within your holdings. And all of that really does quite interesting things to your performance and your portfolio outcomes. The other piece is time. So we looked at some historical examples that used weekly data. I also frequently use daily data in some of the calculations that I run. Both work. You can use monthly for a really longer term look. I don't like to trade that frequently. So I haven't personally tested anything other down below a daily. But there's no reason that this couldn't work with shorter time frame data as well, if that's your preference. The other piece of the time component is how frequently you are considering your portfolio for rotation. Because with an RS portfolio, you're taking your universe, you're ranking it, and then at some point in the future, you're checking in on it and re-ranking it to see how things have moved. So are you doing that re-ranking once a week? Are you doing it once a month? Are you doing it shorter? Are you doing it quarterly? There's pros and cons to each of them. I found in my work that monthly tends to be a nice balance. It keeps you from getting whipsawed out too much with little shorter term events that a good asset recovers from. A lot of people who run more institutional products in this space do quarterly for sort of traditional rebalancing reasons, continues to work at that time frame as well. So again, it's a matter of preference. There's not really a right answer here, but it's worth doing some testing around to figure out, especially if you have your own calculation methodology, kind of what the right balance is for you. I'll throw in, I didn't do any testing on this in this presentation, but I've personally done some looking at like, when does it make sense to trade? Does it make sense to trade, in the middle of the week or at the end of the week or at the end of the month? And I sort of expected maybe that trading on an off time or an off day might give you some edge. But I actually found that most of the time, for what I've tested, those sort of expected round times, end of month, that kind of thing, actually do perform better. So something that's kind of fun to play with and look at as well. Very crucial. You're ranking your list of assets. How are you deciding when something has lost strength, when you might exit it? So there's two sort of broad philosophies to this. One gets most frequently called upgrade, and that's the idea that you always hold the top ranked assets available to you. So if you have a list of 100 stocks and you're holding the top 10, if next time you re-rank, one of your stocks has fallen to 12, you sell it and you buy the stock in the top 10 that you don't own. Lot of turnover on this. Also doesn't give a lot of room for things to go through little fluctuations and then regain strength. It doesn't tend to be my preference, but it does test pretty well. The other and more common option is this idea of cast out. So you have some threshold, and you buy the top ranked assets and you'll allow them to fluctuate a little bit within a set span. So maybe at the 25th percentile, if it falls to rank 30, you sell it. Maybe at the 50th percentile, anything below 50, you sell. These are also preferences and have interesting impacts on both turnover, drawdown, performance. So depending on your methodology, depending on your criteria, this is another factor that really impacts your outcomes when you're building a portfolio like this. So I've been promising the testing. This is what it looks like. To give you sort of just the background of the basic things that I used for the tests that are going to show up in this presentation, I'm using a testing software called RealTest. We've done it in a number of different ones. I personally like RealTest because I'm not a fabulous programmer and it's more building block based. It makes it very easy for me to write, but written similarly versions in AmiBroker, Python. So, use the testing software of your choosing. I'm using Norgate data, which I'm sure with the ATA you guys know well, partially for the constituency component, because I'm using indexes as my lists here, which we'll talk about. And so that's really helpful to avoid survivorship bias. On the practical standpoint, I always include a little bit of slippage. I rarely am the person trading first tick of the open or expecting a perfect fill. So I think it's important from a testing standpoint. I didn't include commission here. Some of the tests go a little bit far enough back that you probably would have been paying commission at the beginning. But since it appears that we're living in a no commission world, at least for a while longer, I left that out for now. If you're trading in asset classes where you're still seeing commission, definitely want to include that in your testing. And as we get to pieces with a little bit of defense in it, where you might hold cash, I'm based in the US, so the Fed funds rate is a good baseline cash yield for us. And so I'm using 0.5% less than the Fed funds rate for yield on cash. So we're going to test 4 RS methods as an example. Robert Levy, the 26-week rate of change, Norman Fosbach's that 30-week moving average, 13-week rate of change, Bob Pierce's with the sort of beta moderated rate of change, and William O'Neill's with his 4 different time frames, quite front-weighted. And I use these partially because they have been in the public sphere for so long. They have been available. Those calculations are available and have been for forever. So it's a really useful example of kind of how much this does continue to work. That being said, there are tweaks that you can make to these, right? This isn't to say that these are the optimal relative strength calculations. When I run versions for myself, it's often, takes one of these ideas as the root and builds upon it or adjusts it in some way. But they do, all of them kind of continue to work. So from a universe standpoint, I'm using the Russell 1000. It's a large cap US index. And through Norgate data, I'm using index constituency to avoid survivorship bias because I picked a quite long test time frame here just as a demonstration purposes. So if none of us know what the Russell was or what the Russell will be in 20 years from now, so it's really important that you take into account that constituency throughout so that you don't basically future leak and have all of your returns based on knowing what the biggest stocks are going to be in the future. And for a time frame, I picked a 20-year period just as of last month end. And the idea was if you're building a test, we'll talk about this a little bit later, you should never actually test something by taking a giant block of time like this. I just did this for a demonstration reason, but if you're actually going to test something, you should always pick a couple of short windows with sort of different characteristics, then leave yourself out of sample data in case you make adjustments. So the first set of tests, we're going to go through a couple of permutations. I picked 15 positions just as a default. Didn't want a million permutations to look through, so I'm not going to play too much with a position number here. But we are going to look at the impact of those 3 different exit metrics. So the idea of upgrade, every time you reevaluate, you hold the best, cast out anything that falls below the 25th percentile, or cast out anything that falls below the 50th. It's nice with the Russell 1000, you get nice, even round numbers. So, anything that's ranked 251st or down would get sold in the 25th percentile cast out. Anything ranked 501 or below would get cast out at the 50th percentile. And I'll give you some equity lines to look at to kind of see what the path was for these. But this gives you just a little initial glance at how some of these work. The left 2 columns, I'm hoping you can see my mouse, but if you can't, are upgrade. And so we see that 3 of the 4 outperformed the benchmark of the SPY for that period. That's the S&P 500. Investors Business Daily, the William O'Neill version, outperformed by quite a bit. Fosbach, almost as much. Levy by a hair, and Pierce came in just under. But as our earlier question pointed out, they all have quite painful drawdowns. And that's true across the board here, and that's something that we will address later in the presentation. Ameliorating those has different knock-on effects, but one of the things about doing a long-only portfolio of the strongest, highest-flying stocks is that when they turn over, they can really turn over. Our middle 2 columns here are cast out at 250. We get both Fosbach and O'Neill outperforming. Fosbach's technically the best. Levy picks up a lot of performance in the difference between an upgrade versus a cast out approach. Pierce continues to just underperform here. And one of the things that I really want to highlight with this, if you're looking at building one of these for yourself, is the right exit metric makes a big difference, right? So thinking about testing these out in a not over-optimized way and figuring out sort of what the right balance of exit metric, it takes a 10% annualized return and makes it a 16% one. So big, big differences. And then we have cast out at 500, in which actually all four of them outperform. We're back to IBD as the top performer. And we keep sort of the nasty drawdowns throughout. So across the board, a real not great statistical methodology, but kind of down and dirty calculation. Across the three systems, cast out at the 25th percentile had the highest average return. Not necessarily the best way to look at it, but we needed to narrow it down for future testing. Upgrade was just barely less in terms of average return across the systems, but it had 3 times the turnover. So that's another thing that you really want to take into account if you're running this in a taxable account and a tax-deferred account. How much turnover you're comfortable with in a portfolio and chasing returns. So no right answer, but something that you definitely want to think through before you implement one of these. With that said, going forward, we're going to test a few other things, but we're going to keep that base set of 15 positions with cast out at the 25th percentile, so that we're not looking at an insane number of permutations. These are the equity lines of those 4 systems if you ran them along with the S&P as a benchmark. So they all got to outperformance in the end here, but they took quite different tracks to get there. Fosback had a really bad time during 0809. It took a really long time for it to recover. It only kind of did right at the end here. Levy took a smoother path up overall, though it stalled out for a 3-year period that you didn't really want to live through. So one of the things, just those top line performance numbers, yes, they give you what your performance would be, but they obscure a lot of that path that you took to get there. So quite interesting to think about that a little bit more. Our benchmark here is the S&P 500, which is this purple equity line for frame of reference. So these are sort of your unadulterated relative strength approaches, no defense, and you feel that in that 0809 great financial crisis, you feel it here in COVID, and you feel it again in 2022 here. One of the interesting things with relative strength is it kind of has seasons, eras, where it outperforms massively and where it struggles. Post-COVID, any relative strength that you ran just absolutely ripped. It was wonderful, felt like a genius. 2022 and even 2021, the second half of 2021, there was so much rotation in the US markets that it was really hard for relative strength portfolios to find their footing, and they tended to have difficulty. So it's another thing that you should keep in the back of your mind if you're thinking about running a relative strength-based approach. They don't go up in a sort of perfectly smooth. They have really, really strong years, and then they have some relatively more challenging years. What relative strength thrives on is when there is consistent leadership that stays strong. It catches that trend and it takes you with it. When you're having one of those years where the index looks good, but what's bringing the index up is rotating every 2 weeks. So, it's commodities this week, it's tech stocks next week, it's utilities the week after. Relative strength will chase that change and really have some difficulty. So, getting back to the question's hidden, so I don't remember the name anymore, but your question about defense. Yes, you can add defense to these, and you probably want to. It depends. I have one that I just let run in all of its volatile glory, and it does really well over time, but you frequently visit some of those big drawdowns. So if you want to smooth out the equity lines, certainly I work in an industry, we run investments for clients. can't throw a client through a drawdown like that. So what can we do to ameliorate that? This first approach is the idea that if you're in a really bad time, let's just phase out. Keep stuff as long as it's strong, but if it becomes weak, let's sell it and let's not replace it until things get better. So I picked the simplest of all sort of metrics for not a good time here, and just used if the S&P is above its 126-day moving average, times are good. If we sell something, we replace it and off we go. If the S&P is below that 6-month moving average, let's wait and see and, not dive back into a potentially the next stock that's just going to roll over and the next stock that's just going to roll over. There are obviously more sophisticated ways that you can do this. More sophisticated isn't always better, but this is just for our purposes today, a really simple way to do it. So we start to see this is the same 4 methods, 15 positions, cast out at 250. We smoothed out the route and we made a big change for a couple of them, especially Fosback. So you start to see those go flat here in the 2008-2009 Great Financial Crisis era. Fosback cuts off above the S&P 500 instead of, living down here forever. And it smooths that return path for all of them. This, as a hedge methodology, something like COVID's going to be too fast for it. When you get that real V bottom and you reverse right back up. And it didn't do a lot for you in 22. It helped a little depending on the system. It certainly smoothed out Fosback's route, but pros and cons depending on the different methodologies. And that's something to keep an eye out for. The right hedge for one may not be the right hedge for all. So pairing an appropriate risk management approach with the calculation that you're using is also a really key piece to get to a successful outcome. So this is a exposure chart that just shows sort of how much the systems are invested. I have them all stacked on top of each other here, so you can't see each individual one clearly, but it gives you kind of a sense of what this looks like. So Investors Business Daily happens to be stacked on top here, so it gets all the way down to 0 exposure for a chunk of 0809. Pierce doesn't quite get down there. It stays in. It's shucked off quite a lot of its exposure, but it's still about 20-25% in. And you get little cutoffs here at various points where you have market turmoil, where you go a little bit and you're not replacing. So option 2, that was still a little bit too much drawdown for you, a little bit too unpleasant. Relative strength has problems. We just want to be out of it anytime that things are bad. So using that same example of just a 6-month moving average for the S&P 500, anytime we get a moving average crossover, we'll just sell all our holdings and go to cash. Again, probably not the version that you would run in real life, but an example for demonstration purposes. And so this really smoothed things out. You gain a lot of value in that 0809 because you get out early and you stay out throughout. Cut out a little bit of the 2010 pullback, and you cut out a little bit of 2022 as well. All of these have a bit of trouble in the recovery off 2022. The things that have been strong aren't necessarily the things that were strong in the recovery, and that's something we'll talk about a little bit later. But if we're thinking about one real weakness and relative strength, when you have a strong environment with consistent leadership, it's great. You catch it, you ride. The things that have been really strong at a market bottom are usually utilities, those real defensive couple of holdings. And so when you get that V bottom, whatever, like the little peak bottom, the things that rebound off of that and that provide the most important performance right off of a market bottom are generally the things that have been hurt the most during that bear market cycle. So relative strength, depending how fast your calculation is, takes a little bit of time to kind of catch up that the old leadership is done with and we've got new leadership now. And this is your exposure chart here as well. So you see, we're all getting out together. across the systems when that situation happens. So you get these chunks where you're in cash. These are the stats across the original version, no defensive approach at all. You get sort of those strong returns, but those ugly greater than S&P drawdowns. Don't replace. So where if you're in a bad market condition, you don't buy again until conditions improve. We see that immediately we pull all of these drawdowns back inside the S&P amount. They're still pretty bad, but we're looking at something that includes the great financial crisis here. And we'll talk a little bit about alternatives going forward. Go to cash brings them in even more. Now you're into the 30s for the most part. So different approaches, but we also see that different systems kind of thrive with different combinations of these hedges. So something to play with is kind of, what's my hedge? What's my drawdown tolerance? And what's my calculation? And how can I best combine those to suit my particular outcomes? So we touched on a few of these as we went through this, but like all systems, relative strength is not perfect. Right after a meaningful bear market low, especially with those slower calculations, it takes them a little while to catch the new leadership. Especially if you're doing relatively short-term reevaluations of your rankings. You might fall prey to short-term volatility events, a bad earnings announcement that hits one of your stocks, and while it may recover in a couple of weeks, if you're checking every week, you'll probably sell it at that point. These are also depending how tax sensitive you are and where you're trading. You get portfolio turnover. It's not as tax inefficient as you would think, actually, because what relative strength tends to do is you get into stocks and they either roll over and you can harvest a small loss and move on, where it tends to let the winners ride and you'll hold them for quite a long time. You will still at some point sell some highly appreciated securities. So if you're very tax sensitive, something to think about, especially if you have a tax deferred account, these can be good systems to run in something like that. And as we've talked about, they're quite volatile. So there's a lot, this was kind of just meant to be a surface thing to fuel the thought around building a system like this. There's a lot deeper that you can go into something like this. You can do more dynamic approaches to position sizing, you can do volatility weighting, you can do strength weighting. There's obviously more sophisticated approaches to hedging than below the 126-day moving average sell everything. So there are some quite nice things that you can play with that provide better defense and more sophisticated defense, but it's about the market that you're trading in, and kind of what works for the calculation that you're doing. There's also quite interesting work and something that I've played with around the best market environments for RS portfolios. And are there sort of certain climates in which you want to be running one of these and certain climates when you want to roll out of this and do something else for a while? So it doesn't need to be your all-weather portfolio. It can be the portfolio that you run for trending environments, for example. So that was a lot of go, we'll accept any drawdown. What if that's not your cup of tea? What if you want to build a system that looks a little bit more at the defensive side? So I have another example of something that's in the public domain to play with today. This is looking at a breadth indicator-based approach to building a defensive technical system. So the goal, and I think it's really important when you're building a system to start with a goal, right? Know what you're building for. Are you building something that is going to be about maximizing return? Are you around minimizing volatility? Are you around minimizing drawdown? And what does minimizing mean? Does that mean I don't want to draw down of more than 5%? In my world, where we're managing for clients, Our comparison is often the US 60-40 portfolio. So something that's 60% stocks, 40% bonds is really the benchmark that we're trying to beat a lot of the time. Because if a client goes to a different advisor, they're getting popped in something like a 60-40. So one of the things that I look at frequently when I'm doing system design is how can we get as much of the market upside or better as we can while giving a volatility or a drawdown profile that's similar to a 60-40 or better. So back to that idea of first principles. If you're looking at building a system and you have, the full breadth of technical analysis in front of you, many indicators, many data sets, how do you pick what you want to use? And this is where I am my father's daughter. And I do think that kind of first principle idea of you want a robust underlying of the indicator that you're looking at. And you want to understand the indicator and understand why it works. If you know that you have a trend-based indicator, if you know you have a supply and demand indicator, you know what the driving forces are underlying your system, then you're going to understand also the environments in which it's likely to work and the environments in which it's likely to hit a speed bump. And if it does fail or underperform, you're likely to understand why. And that's really important to decide, to be able to decide, has this system failed or is this a one-off and the system is still fundamentally sound? The other piece that's really important is to avoid stacking correlated indicators. If you want to use different indicators as building blocks for a system, try to pull one, for example, from volume, one from breadth, one from trend. If you have 5 versions of a volume indicator and they all say go, you don't actually have 5 pieces of confirmation most of the time. You have 5 versions of one piece of confirmation. Looks like we have a question. It says, it seems like you're best off with a very wide universe since you'd want to include the strongest sectors and markets by default. Any reason not to, and any suggestions for filtering your stocks, e.g. liquidity? Okay, actually, that's a really good question. Going back to the relative strength piece for a second. So I do think a wide universe is good, but my exception to that is a liquidity consideration. I often will tend towards something more large mid cap and stay out of the small caps for relative strength. And there's pros and cons to that. So the small caps, when they get going, can really provide extreme outperformance. But they also have tendency to kind of get these big swings and then crash back. And I've been burned by that a few different times. And so I find that some of the trends in the slightly larger stuff is more consistent. I tend to run a couple of filters on my indices in addition. Liquidity, I usually try to use dollar volume for liquidity. Or I guess Australian dollar volume if you're trading an Australian market. So not just the number of shares that are traded, but making sure that a sufficient dollar volume is traded, because if it's a million shares of a penny stock, that's not a lot of volume in reality. I also tend to do a little bit of a filter on price. I don't want to end up in anything that I can't get back out of when I want to. So I will often filter for something like things over $7. It's a bit arbitrary, but a major and broad index with filtered for liquidity. You can filter for price if you want to. I would probably stay out of things that are too sector constrained, unless you have a mandate or you just like really love metals and you only want to be trading metals and this is your metal system and it's going to get put against other things. But you want to find strength where it is. So the broader the list of things that you're looking at, the better chance you are of having that source of strength in your list. I also tend to filter for things that have been around for a little while. Um, you obviously need the amount of time that your calculation requires. So if it's a 30-week moving average, the thing needs to have been around for 30 weeks. Um, I don't really want to play with the right after IPO bubble crash hype cycle. So I tend to require that things be around for something like 2 years, at least 1 year, before I put it into my list for consideration, just to let a little bit of that kind of early weird movements of people of like major insider holdings who have been in 6 month or 1 year lockups, that kind of, I want all of that to work its way out before I consider it in my list. So I hope that helps, but definitely do filter for liquidity, most of all. Okie dokie. So back to the breadth piece. Our today's first principle, very, very first principle. New lows are bad. If the market's making a lot of new lows, not a great sign for the health of the market for the near term. And for our little public sphere published sample indicator, I'm using today a piece of work by Ralph Vince and Larry Williams. It's the Dow Award-winning paper from the CMT Association for 2024, The Ripple Effects of Daily New Lows. The paper's in 3 different pieces, all really interesting. I think it's worth a read in general, but I'm picking for today the 3rd piece, which is something that they call the bloodbath sidestepping 4% rule. Doesn't quite roll off the tongue. I'll jokingly call it bloodbath, though if you're talking about building something, telling them that you're putting them in the bloodbath system may not be the winning strategy. But it's a pretty simple idea. I love a simple idea for a system. If it makes sense to me, then I have confidence in it. Basically, if any given day has more than 4%, if you're looking, sorry, let me back up. So if you're looking at a universe, they use the New York Stock Exchange, everything listed on the New York Stock Exchange. If on any given day, more than 4% of the listed securities on the New York Stock Exchange are making new lows, it's a bad sign and you want to get out of the way. And this is straight from their paper, copied and pasted, an illustration of when that was true. The red bars kind of show us those times. And we see that, you get a lot of these periods with new lows in periods that you really didn't want to be in the market. You take out a chunk of the financial crisis, a lot of the big nasty declines. You also get some of it on some little declines that don't materialize into anything much, but generally, most of the time when you really didn't want to be there, this seemed to be a true occurrence at that time. And something like this can be a nice way to look at an indicator, and try to evaluate whether it's doing what you want to do. I like to do this, kind of just chart it graphically against an index and say, is this signaling at the times that I would want it to be signaling before you start building it into something and running back tests. So an indicator is the starting point. You have, or a stack of indicators, as the case may be. But it's your trading rules that are really going to determine the outcome. So what are your buy and sell rules around an indicator like this? And there are a couple of sort of base pieces to it. What type of system do you want to run? Is it an always in? Are you going long and then short when you're not long? Is it in out? Are you long or in cash? When are you trading? Is it an intraday system? Are you trading it today? Is it a daily system? If it's daily, today's closed, tomorrow's open. All of these, if you're building a system and if you're testing a system, are going to have, maybe not surprisingly, but surprisingly huge impact on how everything tests out. So for this paper, let's stick with what they did. they said that on the close of a day that's seeing 4% or more daily new lows, sell, short, hedge, whatever version, get out. These aren't, it's not looking for 4% of things to be making new lows at the close. It's at any point during the day. So by an hour before the close, if 4% of things have already made new lows, you have a sense pretty early in the day. I mentioned earlier in the RS piece that I'm not a super frequent trader. I like things to be a little bit more trendy. So I'm adding one piece of my own to this so that I'm not quite whipsawed in and out on a one-day basis, and looking for a 3-day moving average of new lows to be greater than 4%. So you can still calculate this an hour before the close and know it in time. But I just personally don't like doing a ton of, oh, we're out today, we're in tomorrow, we're out today, we're in tomorrow. It's a little too much. So I want to see new lows picking up a little bit before I sell. Per the paper, the re-entry approach, or turn off your hedge or exit your short, depending how you're running it, is the first subsequent day where new lows are less than 4%. I'm doing the same thing on the flip side. Let's see the 3-day moving average dry up, and at that point, we can hop back in. Yep. Okay. Sorry if this is a dumb question, but what is a new low? Okay. You are right. I actually should have said that. Per the paper, they are looking at 52-week new lows. So a stock that is making the lowest price that it has made in the past 52 weeks. So for your annotation, it would be low is less than the lowest low value of L, 50 if you're using weekly data, or 252 if you're using daily data, is how they're looking at it. But that's what the paper says. It's not a hard and fast rule. So you could play with a version of this looking at a shorter time period. You could play with it 26-week lows. But the underlying idea here is that a chunk of stocks are really all moving down and doing badly at the same time. And that when that starts to happen, it's a signal that there is an unhealthy market environment and you want to get out of the way. So I wrote this to be simplistic, also because I just don't short a lot. So I tend to favor long versus cash rather than long short strategies. I know that in their work, Vince and Williams certainly do a long short version. But for today's testing, we're looking at selling and going to cash if the 3-day moving average of new lows is greater than 4%, and re-entering when the 3-day moving average of lows is less than 4%. So how does it work? A few notes on testing before we get into looking at the actual equity lines. I'm going to show you another nice big long chunk to kind of illustrate the characteristics of a system like this, but you should obviously never test anything like that. In sample versus out of sample data for testing, crucially important. You want to pick a small set, maybe 2 or 3 representative chunks of time out of your window and test on those, leaving time that you haven't tested on for once you've done all of your testing and tweaking and playing with things, that you can run your test on a clean set of data and make sure that it still works. I found that I was defaulting to kind of picking the same little representative pieces for my testing. So now I've actually taken to making AI randomly pick my testing windows. Saves me from always, I kind of know, oh, this bear market, that uptrend. And I find it actually works pretty well. I'll just ask ChatGPT, pick me 3 one-year periods after 2006. I'll test on something like that. We talked about this a little bit on the relative strength side. not as relevant to the piece that we're testing here, but if you're buying from a candidate list like an index and you're doing a back test, so if you're filtering your index for for liquidity, like we talked about, any of that, make sure that you're doing it the same thing throughout your test. So make sure that you have make sure that you have an index with candidacy so that you're looking at the actual components of that index at that time. Make sure that you're screening for those same things. If you want to look at liquidity, do all of that in your test for those little periods and try not to future leak, and it'll save you a lot of pain down the line. This is something, the last piece I feel like you've probably all heard already, but this is something that I don't hear talked about as much, but I think is super valuable. So you've done your early testing, you found something you really liked. Check for robustness. Change all your parameters a tiny bit. Make your time period one day longer. Make your threshold, rather than 4%, make it 4.1%. Make your exit 4.1, your entry 3.9. Just tweak everything a tiny bit, and it should change your results a tiny bit. If it changes your results night and day, then what you have is luck, not a functional system, and it will fail you when you put it into actual practice. I tested a version of a relative strength methodology once and thought that it was, the greatest thing since sliced bread. And I did a robustness check, tweaked my parameter a tiny bit, and realized that all of its performance was a single trade that it had caught. And if it hadn't caught that trade, it really didn't have much to offer me. So those little tweaks shouldn't adjust your outcome very much. And it'll save you a lot of grief to check it at the beginning. And once again, do not over-optimize. Once you've tested those little windows that you've given yourself and you're done with your tweaks, test on your out-of-sample data. If it doesn't work, you're done. You need to come up with a different system. Do not start to tweak in your out-of-sample data, because then the real world becomes your out-of-sample data and you'll think you have something that works, and the actual market will teach you a lesson in profits. Super important. It's okay to let a system go, but tweaking it into perfection and then finding out that it's not perfection in the real world hurts quite a lot. So, all the preludes aside, here's our actual demonstration test. I'm going to break all my rules and show you a really long test just to illustrate the system. Obviously not how you would test if you were going to run the system. So I'm using that same 20-year time period as of last month end. We're doing that long or cash rule, so we're either holding the S&P 500 or we're holding cash. And the same parameters as for the relative strength. When we're in cash, we're earning 0.5% less than the Fed's fund rate. We have slippage and we don't have commission, using real test and NOR date. And so here we see our results. And part of why I picked this actually is because it's not perfect. And I think that illustrates something. So this adds a lot of value for us. I'll go back. We have 3 lines on here. We have the green line, which is our system. We have the red line, which is the S&P 500 buy and hold. And we have a 60-40 benchmark because that's what we set in our goals to begin with. We want outperformance with 60-40 like drawdown. So we do really well here. You have some drawdown in 08-09. It doesn't go flat. It's not a system that's designed to go flat for long periods. But we get much less of a drawdown than the 60-40 and much, much less than the S&P 500. And through the intervening years, we have something that I like to see in a system up until we hit 22, where we see these lines getting further and further apart. We're a little bit above the 60-40, we pick up additional gain on the 60-40, our compounding return is getting broader. It's really easy with defensive systems to have an equity line that looks really good, but realizing that you're kind of only getting value at 2 points. You cut off 2 potential drawdowns, and otherwise you're doing S&P like or a little bit less than the market or a little bit less than your benchmark. So what I really want to see in a very good system is something that kind of continues to pick up compounded growth against the index or against my benchmark over time. This does really well against COVID, saves you almost the entirety of the COVID drawdown, and then it really falls on its face in 2022. And I left that in there because for a couple of reasons that we'll talk about, but I think it's important to think about the fact that there's not necessarily one perfect system, and you can try to fix things, but most approaches are going to run into some trouble in one environment or another. And it's important to remember that and kind of account for it. So this is our drawdowns. Got 27%-ish in the Great Financial Crisis. S&P was about 55, so it's not cute, but we're pretty happy with that on a relative basis. We've got a similar to slightly larger drawdown in 22. We're not happy about that. We're really happy in 2020. So, pros and cons. We did a pretty good job most of the time, with one notable exception. And since we set our goal at the beginning to do a 60-40 like drawdown, I've overlaid the 60-40 drawdown on here in yellow. So we definitely beat it comfortably during 08-09. We beat it comfortably during COVID. In these little drawdowns, I'm less worried about these kind of smaller, under 10% periods. Not super notable. But this, as we said, was not great. And this gives you, it's a 20-year period, so it's pretty compressed. But this gives you a sense of what your exposure looks like. You're in the market about 85% of the time. So what's our performance look like? The S&P, if you bought it and held it for that period, gave you that 10.81 with a drawdown of 55% that we saw in the same as the RS testing. The 60-40 gave you substantially better drawdown, still not nothing by any means at 35%, but you gave up quite a lot of performance for it. You gave up, 3% basically annualized return for that drawdown protection, which really adds up over time. And so using the bloodbath work, we got a 13.36% compounded return, which is quite nice. And we did hit that goal of less than 60-40 drawdown in aggregate, but not necessarily in each specific drawdown case. Its max drawdown was less, but we know that it had a little bit more in that 22 window. So I put up these stats, less because I want to extol the stats of this particular system, than because I think what stats you look at when you're defining and designing a system are really important in helping you evaluate the success of your system. So everybody does a rate of return, everybody does a drawdown. The institutional world, Sharpe is everything. But Sharpe has sort of the flaw of it penalizes all volatility, up volatility, down volatility, where we may want to capture up volatility, but not like down volatility. So something like a Sortino ratio might actually be a better indicator of success for us. A higher Sortino ratio might be really what we're looking for on a defensive side. Similarly, an Ulcer index, which compares your return to your maximum drawdown, if what you're trying to do is control drawdown, that might be a more effective way for you to look at if you're building a couple of systems for the same purpose, might be a more effective way for you to look at this. Average exposure just gives you a sense of to what degree you're in the market. What's your turnover? How often are you trading? This over 23 years traded 93 times. That averages out to about 4.5 trades a year, though that's not particularly an accurate representation because it trades, for example, quite a bit in 08-09, and then there's a couple of years where it trades once or twice. So it's not necessarily a smooth 4.5 every year kind of thing. The other thing I put up here was the win percentage and the size of your average win and the size of your average loss. If you want to improve, I'm probably going over stuff you guys know here, but I think it bears repeating. If you want to improve the outcome in a system, there's kind of two metrics that you can move that will result in better performance. You can improve the percentage that are wins. This is, about 50-50. So you could try to tweak your system and adjust it so it's more like 60-40 rather than 50-50 in how many of the trades are winning trades. Or you can have your average win be greater than your average loss. And so you can kind of try to improve that and nudge the size of your wins up versus nudge the size of your losers up. And a lot of this is kind of psychology, like what works for you. I know traders who have systems that have terrible percentage win rates. They take a lot of small bad trades and then they get some home runs. And it really works for them. And I know people who it would just absolutely crush their soul to take that many bad trades in a row before they get their home run trade. So there are people who want, a really high win rate and they'll take a lot of tiny wins, rather than take a lot of losses and then wait for that one big win. There isn't a right answer on this, but picking a system that has a style that works for you, that you can trade, that emotionally you can repeat over time is maybe the most important thing, because you can have the best system in the world. You can have a system that is the key to the universe. And if it doesn't fit you psychologically and you can't stick with it and you can't take the trading signals, it doesn't mean anything. So the existential question, you have a system like this that works quite well over time, but it has that one big flaw. In this case, it's that 22 drawdown. Do you try to fix it? Again, no right answer here, but some things to be really mindful of. So every time we have a really bad market event, 87 crash, 0809 great financial crisis, COVID, 2022, every time we have one of these, everyone goes out and designs a system to avoid the last bad thing that happened. And it's purpose built for that. And then the next bad thing that happens could be a total surprise with completely different characteristics. So you do want to make adjustments as needed, but you want to be careful about overfitting to one specific bad event. And there's always this balance between downside protection and upside potential. With relative strength, you get, if you leave it unadulterated, you get some really big downside, but you're rewarded with really big upside over time. And as you try to limit that downside, you shave off a little bit of the upside for every kind of increment you make and reduce downside. And so it really has to do with what your goals and your risk tolerance are. But be aware that that trade-off is pretty unavoidable. And we touched on this, but the more you optimize to the past, to one specific past event or even two past events, the more likely that the market's going to throw something new at you in the future that you've optimized yourself so that you're now not suited to those sort of broad set of events that can occur. So another way that you can look at making adjustments to a system like this is kind of stacking different assets. So different assets have different characteristics. What if instead of doing the S&P 500, using all the same rules, we do the NASDAQ 1000? We're using the QQQ ETF. And I said the NASDAQ 1000, but I meant the NASDAQ 100. So higher, more go-go index, more go-go results, right? So the S&P itself, if you bought and held it, would have gone up 10.8%. The NASDAQ would have gone up 15%. And so running bloodbath on the NASDAQ gives you sort of a proportional increase over the index. But because it's more volatile in general, you also pick up drawdown. So here's the equity line. We've got our same old 60-40 benchmark now in blue, our S&P 500 benchmark in red, and I've added the QQQ benchmark so that you can see that as well. And and we see the bloodbath in green on top. So we, again, handle 0809 really nicely, handle COVID really beautifully. This not so great. So what can we do? We've highlighted that there's a not so great moment. One thing that we can do, this is a long to cash example, can do something other than go to cash. You could do a fixed income allocation, something that's supposed to go up when the indexes are going down. Ironically, since this one underperformed in 2022 was the rare occurrence in the US markets where fixed income right down alongside equity. So that would not have fixed your 2022 issue, but could be an interesting thing to look at in the long term. You could hedge instead. You could go short instead of doing cash. You could plug in a different system. Maybe you have a mean reversion system. Maybe you have something that tries to buy dips or is good at reversal points. So you can stack in something else to try to compensate for those times. You can add other indicators to the system, right? This is a super basic example that we're looking at, a single indicator, single rule set. Can add some confirmation. Maybe if XYZ is happening and bloodbath hasn't gotten me out, I should go out based on a different indicator. You can stack these in to help refine entry exit points, to help you avoid specific drawdowns. A little bit of a broken record here, but be careful that you're not over optimizing. My personal preference is, rather than try to build one perfect system, I'd rather have a set of systems that I know perform differently in different environments and stack them together to counterbalance each other. You can do the same thing with a different set of assets using one system methodology. You can do combinations of the both. I think it's really hard and possibly impossible to come up with the one system that is going to solve every problem for you, that's going to fix every issue, that's going to meet every market challenge at its very best. Relative strength has up times and sideways times. Something like this has drawdowns that it catches beautifully and drawdowns that it misses. So I'd rather have a set of things that I know work most of the time stacked together than risk really over optimizing to try to get a single perfect outcome. Other things that when you look at a in-out sort of drawdown minimizing system, taxation is always a little piece to worry about. If you are selling out of an index at a high, going to pay taxes on that. Might avoid some of that or mitigate some of it by using an inverse fund or a hedge of some kind rather than selling your position. So rather than going long to cash, maybe you add a short position at those times. But certainly something that wasn't in this test that you want to know before you run something in the real world. And as we kind of draw to the end here, these were both on the relative strength side and on the defense side. Pretty simple examples. They were straightforward. They're things that are in the domain. And you can tweak them and you can improve on them. And I think that you should, and I certainly do for my own investments. But, everything in moderation. The most complex system, adding one more indicator to create a little bit of counterbalance could be great. Adding 16, maybe too much. There's no right number, but a little complexity can help. The most complexity, not necessarily better. So as we kind of wrap it up, we're in volatile times, right? We're in interesting markets. We got a lot of news going on, stuff's moving around. Tactical approaches, technical analysis-based systems, they can give us a really big advantage. We can take advantage of upside volatility. We can try to avoid a piece of that downside. Never going to avoid it all, but we can chop a piece of it off. And we can try to avoid that sort of sad, endless drag of just carrying a defensive asset in our portfolio perpetually. We can try to be a little bit more timely in our adjustments and, reap those benefits as they compound over time. And the real takeaway is that it's about process, right? The markets are always going to come up with this time is going to be different. It's going to be a pandemic. It's going to be a tariff scheme. It's going to be, there's always something, right? And if it's just us making purely discretionary decisions based on what's happening around us, it's tough. It's not impossible, but it's tough. So going through a rigorous building process and creating a rigorous strategy that we have confidence in uncertain times can really help, having that system that says, hey, things are, some new lows are building up. Maybe we need to be a little cautious. Or, tells us that we're hitting a bottom and everything might feel bad, but it's time to buy. And we know that we have a method and a structure underlying that. It goes a long way to helping us in difficult times. And so I think there's, especially being in the world of TA with all of the tools and all of the indicators at our fingertips, I think we can build really great stuff that really supports us and helps in our process. So, follow the method and really focus on your goal. Know what you're building for. Is it defensive? Is it offensive? And kind of keep that in mind as you go through your process. And I see that I have one question. It says, do you ever try to use the data from your live trading to feed into the strategy? An example in real test would be trading the equity curve, where the strategy goes flat if its equity is less than the moving average drawdown. Do you think this helps mitigate the static data used during backtesting and adapting a bit to future market conditions? So I'm aware of people who do it, and I think it has value. Being perfectly honest, I have not personally done it. There was a really interesting conversation I had at a conference last week with someone who rotated amongst a set of strategies so that they were only running a subset at any given time. They had basically a stable of strategies and they ran a subset of any given time, and they kept the equity curves for all of them throughout, and they fed them into an algorithm that helped them select which strategies that they were going to run at any given time. I think there's a lot of value there, and I think it's really interesting, but it's not something I have a ton of personal experience with. So that would be my answer. What do you look for in signs that a strategy is no longer working? So it's a really good question. And to me, it comes back to understanding why the strategy is not working, and understanding what the kind of underlying pieces of your strategy are. If I think that the fundamental conditions that I built, not fundamental analysis, but sort of the building block pieces of why I created the strategy are still true, I'll accept underperformance from a strategy for a period of time. Certainly true in relative strength. No one really enjoyed the second half of 2021 in relative strength, but the fundamental idea that momentum and outperformance continues to work, there was no reason for me to think that that was broken. And indeed, we returned to periods of real outperformance after that. So as long as I'm confident that the base of the strategy is still sound, I will kind of continue to give it grace. If I think that there's something in the strategy that was built on something that no longer works, then I'll start to say, it's time to move on from this. So like the classic example, which is really before my time, is like odd lots trading, right? So it used to be able to tell sort of institutional money from amateur money by whether they were trading around lots of 100 stocks. And that was 100 shares. And that was really valuable for a long time. And then it died as trading dynamics changed and decimalization. And I think that, kind of continues to be true in a number of different ways. So I would say don't abandon your system just because it's going through a rough time if you think that the underlying is still true, because I think it's quite easy to toss the system out after 3 months or 5 months of underperformance. Mean reversion went through a tough time a little while back. That's just the nature of things. Nothing works all the time. It's why I like to stack different approaches. but look at what's underneath. And if you think what's underneath is rotting, then toss it. Has my period of time changed over the years? Yes, I have gotten slower. When I first started, I think as many younger, newer traders are, I was like, the fastest version is going to be the best version. To stick to sort of the parameters of what we talked about today, I was like, relative strength, daily data, reevaluate it weekly. Definitely better. Like the faster we change, more interested in upgrade than cast out. Like let's be on the best, let's be on the fastest. And I've actually found that for my personality, I don't want to be glued to the computer intraday, trading little like tweaks. You can be super successful doing it. It doesn't work for me. It does make me happy. So I have, for the relative strength example, gone to more things that evaluate on a monthly basis, more things that capture some of those longer term trends. So yeah, I've slowed. How do you adapt these strategies across different asset classes, equity, bonds, real estate, etc.? I'll be honest, I am very heavily an equity trader. I don't do much in bonds. Generally speaking, very little, certainly directly in bonds. A lot of that has to do with sort of the liquidity of the US bond market and the size of the spread. If you're trying to buy individual bonds, like really just kind of eats you alive in terms of your alpha. I do, I have a system that I run that ironically, since relative strength is our part of our theme for today, the bulk of the system isn't a relative strength system, but it has a little alternative sleeve where I have a set of ETFs that include, floating rate bonds, high yield bonds, the general bond market, some ultra short term, along with real estate, utilities, a set of these sort of counterweight assets. And that sleeve as part of that strategy uses a relative strength to kind of pick the assets that are providing a beneficial counterweight to the more zippy equity side of the system. And so I find that works well, but in a way, by using the ETFs, I'm just converting these other asset classes into equities as well. Yeah, not a great answer to your question, but hopefully helpful.
Well, that looks like the question is drying up, Zoe. So I just want to take a minute to say thank you very much for a very insightful presentation. I certainly picked up a few things there that I'm going to take away.
Oh, good.
I think the key message about being focusing more on robustness than outperformance, I think, is a very
Yeah.
salient one that a lot of people should think about when they're going into system development. So thanks very much for your time today and your vast knowledge, especially coming from the institutional world. I think it's always good for retail traders to hear how things happen on that side of the business. And thanks everyone for joining us today. Oh, we do have a couple of other questions come in, so maybe we'll just answer them before we wrap up.
Yep.
Yeah, go
Let's see.
ahead.
Were those QQQ bloodbath and SPY bloodbath back tests using your 3-day MA new lows or the paper style of new lows? Oh, they were using the 3-day moving average. Um, those back tests were using the 3-day moving average just because it's the way that I would trade it realistically if I were to use something like that. I just don't like stuff that waffles that fast, 1-day trades in and out. So the back testing were all like per that rule set that I put up using the moving average.
Great. Thank you.
Yeah.
And there will be the session has been recorded. The recording will be uploaded, and everyone on the call will get a link. So look out for that in your email inbox. In the meantime, thanks again, Zoe, for giving up some of your evening for us, and we look forward to hopefully seeing you in person one day over here.
Thank you so much for having me. It was always a pleasure, and thanks for the great questions.